They are panicking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, secret fears are revealed as regulators' jaw-dropping concerns are exposed as banks face their next crisis. Let's over to Bloomberg, where we picked today's story up with a headline: top U.S. regulators flag increasing commercial real estate risk. And why this is such a big deal is because if you listen to the Fed and you listen to other policymakers, they really actually believe we're going to have either a no landing or soft landing, that inflation is eventually going to come down due to tighter monetary policy. They believe the labor market is going to stay strong through the rest of the year and the economy is going to be okay. But there's one place, if there's one thing they cannot stop, it's what's going on in commercial real estate, and that really has them scared. The Financial Stability Oversight Council said in a statement on Friday that delinquency rates are low, but empty offices are on the rise. Now, the reason we're seeing that is because when you're under a lease, it doesn't actually matter if you're occupying the building. So if you have a 12-month lease and 6 months into it, you pack up and leave, well, you still have to make the payments. You can't just say, hey, you know what, I'm not there anymore, so I don't want to pay. So one of the concerns here that we're seeing is vacancy rates are rising, delinquency rates remain rather low, but what's going to happen as these leases come due, of course, the occupants aren't going to renew them. The landlords are now going to face a problem because they don't have the revenue to pay on the loan. And next thing you know, delinquency rates are going to head a whole lot higher. After several wild months in finance, during which 3 mid-sized banks failed, Washington's watchdogs are under pressure to get in front of any looming issues. During the Friday meeting, the regulators discussed the ability of market participants to manage their interest rate risk and liquidity risk in the current economic environment. Now, why this is such a big deal is you go back to the banking crisis earlier this year, and what did all the regulators tell us? We didn't see it coming. We don't know why this happened. And that's not something you go to Congress and tell them, because it's not the answer they want to hear. Because if you don't know what's causing this, that means it could happen again. And if it happens a second time, there's going to be outright panic. But let's go back to this piece here and look at what they said. The ability of market participants. So they're not even acknowledging that perhaps there's anything that the Fed's doing to cause this, to manage their interest rate risk and liquidity risk. So essentially what they're saying is, look, it's not our problem that interest rates went up and you didn't hedge them properly. We told you we're going to raise them. It's not our problem you're having a liquidity issue and the deposit flight is real. It has nothing to do with the fact that as the Fed, we've raised interest rates and are backstopping money market accounts. No, none of these things have anything to do with it. But yet it's your problem, banks. And really, this is why we're making the case that eventually the Fed's going to be back at zero faster than anyone knows, because when the next bank goes, it's not going to be one. It's going to be a domino effect on the backs of commercial real estate. Overall, the group, which is known as the FSOC, said the banking system was well capitalized. We're going to make a big argument against that here in a little bit. The Fed and the Federal Deposit Insurance Corporation have been peppering lenders with questions related to interest rate risk and commercial real estate exposure. Well, they actually know about the commercial real estate exposure. Fed Chair Jerome Powell on Wednesday said, we do expect there will be losses in commercial real estate, and the banks have concentration in that area will experience bigger losses. Well, that's pretty obvious. Yes, if there are losses, the banks that hold more loans, Jerome Powell, will absolutely indeed take more losses. The problem is, as we talked about on this show, it's a lot of these commercial real estate loans are held by small and mid-sized regional banks. Hardly any of them, relatively speaking, to the bigger pool of commercial real estate is held by the large commercial banks. And even if there was a bunch there, they can absorb the losses. These small banks, they have no capacity to take any form of losses going forward without watching them outright fail. And here we can see what's going on with commercial real estate prices. We have that in red. The concern now is, will prices come down? Many people don't believe that, because if prices in commercial real estate come down and the banks, as we've talked about, have these massive number of loans they have to refi this year and next year, well, if prices come down, that means the loan value needs to be paid down some. It's not obviously going to happen because, of course, that's not what the borrowers are doing. They keep making these interest-only loans. loans. So that means you've got a problem at the banks. And we can note it all comes back to tighter lending standards, as it normally does in a debt-based economy. Here you can see the net percentage of domestic banks tightening standards for commercial industrial loans at all size banks in blue. So we note that when the blue line's above that horizontal black line, at any point they're on net tightening. And what happened to commercial real estate prices on a year-over-year rate of change during the global financial crisis? Well, they went down, and now they're starting to. But the broad belief, and I'd love to get your opinion on this, the broad belief is that commercial real estate, the prices where they're at are fairly stable. They might ebb and flow a little bit, but there won't be a big correction. I'm saying they're going to. If there is, that means all of these banks holding these loans are going to have to put even more money in reserve. And commercial real estate is melting down fast as Elon Musk warns home prices will be the next. And so let's take a look. As commercial real estate is melting down fast, he said, home values, of course, coming next. As the Tesla CEO pointed out, the work from home trend has substantially reduced the use of office buildings around the world, and that does not bode well for commercial real estate. And this is a case we've been making on the show for a while now, is that the reason we're seeing these vacancy rates increase, the reason we're going to see a lot of these leases not renewed, and the next thing you know, the landlords are going to have no choice but to stop paying on their loan, or they're going to have to go back to the bank and say, look, we're only at half occupancy. We can't afford this loan. You've got to write this loan down and absorb the loss. The banks are going to say, we have no capacity to do that. We can't take this loss. And all of a sudden, you're going to see these bank balance sheets of these smaller, mid-sized regional banks once again collapse. Their stock price will come down. Everybody's going to feast on them, and they're going to blow out. And as many of you pointed out in the comments before, this will just be easy picking for big banks like JP Morgan to pick up more of these bad assets and absorb them into the even larger commercial banking system. But the problem is, again, work from home, which is why I've made the case in the past that at some point in the future, maybe during the next recession, there'll be a big push to get people back into offices, meaning you said, no way. And almost all cities at this point have record vacancies of commercial real estate, according to Musk. We know this going into this big 2-year refi boom. It's going to be a really head turner, as banks will have no choice but either to write these loans down or perhaps fail. And commercial multifamily mortgage delinquencies are now on the rise in the first part of 2023. But one thing that should also be on the rise is your trading account. As you can see here with our CTA-Timer Pro, the tech rally continues. Many of you said you missed it. You didn't have to. Our report said right here you should be buying. It said if you missed that, you should be buying in here. In fact, one recent subscriber said, look, I just followed the report now. When it gets to that deep short position, when it starts short covering, I just start buying. He said it's the easiest thing I've ever done, and it works. He said almost every time. And here you can see back in the reports, this would have been that first short covering back on January 9th. We saw that with the QQQ. All you had to do is follow the report, if nothing else. We always, of course, encourage you to use your own signals as well. But here we can see on March 15th, we saw the machines buying out of that dip. Again, giving you an additional signal there. Many of you have asked, when this thing reverses on the tech thing, we want to know. We'll show you that. Hasn't happened yet. Remember, 30-day risk-free money-back guarantee. Link in description below. $30 while it lasts. Delinquency rates increased for every major capital source during the first quarter, foreshadowing additional strains that are likely to work their way through the system. And so what we're seeing with delinquency rates is it's highly correlated to tighter lending standards. So of course, of all things, banks now are forced to tighten lending standards. Then it means delinquency rates are going to go up. And you know what follows rising delinquency rates? Well, if you said rising default rates, you've got it perfect. Check this out. Even though delinquencies, they're saying they remain historically low, it's correct. But look at the year-on-year rate of change. Here you can see lending standards get tighter, delinquency rates in red on the way up. We see that during the global financial crisis. We saw that during the pandemic, and we're seeing it now. And yet the market believes here that commercial real estate prices will stay stable. I say it's highly unlikely because a surge higher in delinquency rates will put even further downward pressure on prices, particularly as more and more broadly vacant buildings hit the market. There's nowhere but price to go down. And yes, this means the regional banks are now going to face not just a little bit of trouble, but potentially years worth of trouble, as they'll be focused on strengthening their balance sheets and trying to keep depositors and regulators happy for a long time. And that's going to be a huge challenge for these banks, because as we're going to show you in a little bit, deposit flight is still a real problem. So at this time that they're facing this commercial real estate refi boom, and which is going to be more of a refi bust when they find out where values are sitting at, they're also facing the fact that they're continuing to see deposit flight. They're going to need more government bailout, or you're going to see a whole bunch of them fail in a not too distant future. Unfortunately, it's also true that these banks are spooked. They'll be focused on strengthening their balance sheets and trying to keep depositors and regulators happy for a long time, even as a continued threat of broader banking system trouble hangs over them. And this doesn't mean banks are all doomed, which is good, because we do need some of them to survive, but it does mean, especially if the yield curve stays inverted, that more banks could fall over. It also means that banks will be constrained by more watchful government overseers. So what we're seeing here is more people start to believe and admit that perhaps the inverted yield curve is causing a bunch of the problem in the banking system, which it is. Now, maybe this is the reason behind closed doors we saw the Fed actually pause at this last meeting, even though they're talking about further rate hikes, because if they continue to hike, they're going to further invert the curve, and that means more stress on the banking system at a time, as you'll see here in a bit, that they can't handle any more stress, because the stress is getting worse every week. And here you can see that yield curve. If you wanted to paint a picture of what a banking crisis looks like, you would start with this chart here. Anytime you see this blue line below the horizontal black line, that is an inverted yield curve. That means short-term interest rates are higher than long-term interest rates, and that tells us that banks can't make any money, because remember, they borrow at the short end of the curve and lend at the long end of the curve. And when you have less money being created because you have fewer loans being originated in a debt-based economy, you start to run into what's called a dollar shortage, and that means that you'll see a lot of loans hit into delinquency and eventually default. The banks can't absorb it, and this all starts to come back and point fingers at the Fed, who, and you saw in the first article, remain about clueless along with the other regulators at what's causing any of this problem. After the Fed's triple whammy comes in another blow, banks will have to hold more capital as threats of more regulation hit the banks, and they're not in a position to do that. That means cutting the cash paid out to shareholders through buybacks, holding or cutting dividends, slowing lending even more, which would be dangerous, and perhaps issuing new stock with no one will want when it comes crashing down. And none of these are good news for shareholders, but could be warmly welcomed by creditors, maybe or not. As the Fed emergency bailout facility usage now hits new record high, money market funds see small outflow. So this is a big issue here, because the Fed is backstopping these small and regional banks. What we want to see is, over time, their usage of these Fed facilities go down as they pay these loans back, showing that, hey, we are becoming financially solvent here again. If we see continued increases in them, as you're seeing now, what it tells you is the problem in the banking system isn't getting better, it's getting worse, and that is a huge problem. And most notably, the U.S. Central Bank had $106 billion of loans outstanding to financial institutions through its two backstop lending facilities, up $2.26 billion from last week, which is not a good sign that the banks are getting healthier. When the bank's usage of the Fed's emergency bank term funding program is rising once again to a new record at $102 billion, up $1.8 billion from last week. So again, these programs, the second one is that bank term funding program, is where you take your existing treasury securities or other securities, you go to the bank, you go to the Fed, even if they're upside down, doesn't matter. The Fed is going to give you full par value for cash, but you've got a maximum of 12 months to pay those back, and so far it's not looking like they're going to pay them back at all. And finally, as a reminder, Zero Hedge notes, banks have 9 months left under the original 12-month bailout program to find a way to stabilize their balance sheets and get these loans paid back. And not only have they failed to do so, usage of the BTFP facility, as we just noted, is at a new all-time high, and yields rising even more, putting even further stress on the banks. So what you're seeing here is it's not working. And this is how you know that rates are eventually going to go back to zero, because when the banks finally hit the wall, the red line where they can go no further. You're going to see them start to fall over again. The Fed will have no choice but to extend in perpetuity this lending program. They'll have no choice but to take rates back to zero. And for those of you who don't think rates can go back to zero, let me just share with you this. That is the only tool the Fed really will have. Beyond quantitative easing and quantitative tightening, we'll set that aside for the moment. The primary policy tool is the federal funds rate. If you don't think the Fed will have a knee-jerk reaction and just go to zero because they don't know what else to do, well, that's all they'll have to do. Probably more QE, maybe not right away. First move, funds rate back to zero. And unfortunately, it won't be fast enough to stop the banks from failing. And commercial real estate is the next shoe to drop for regional banks and the stock market. As we've been pointing out here, what we can see is commercial real estate is widely seen as the next shoe to drop as lending standards for commercial real estate loans tighten even further. Remember, we've shown you the charts in past shows that as the yield curve stays inverted or gets further inverted, banks tighten lending standards here. We know the Fed has paused, the curve has stayed inverted. If they continue to hike or continue to pause at future meetings, regardless, that means the curve is still inverted. Banks are going to be forced to continue to tighten lending standards, and that means delinquencies on the rise and eventually into defaults. And what's not helping is the fact that occupancy rates across the country are still far from their pre-pandemic levels. According to Hartnett of Bank of America, office occupancy rates are still less than 50% as work from home trend persists. And at the same time, growth in national rent levels peaked over a year ago, has been steadily falling according to Zero, which means that of the office buildings that are collecting rent, it's likely less than it was in the past, which we could have probably predicted easily. All this means now is, of course, there's going to be huge problems. We expect about 21% of commercial mortgage-backed securities outstanding office loans to default, which is a whopping number, with a loss severity assumption of 41% and forward cumulative losses of 8.6%. Applying that 8.6% loss rate to office exposure, it would imply a $38 billion loss for the banking sector. You can note, of course, that's from JP Morgan, who would know nothing more probably than the small and regional banks to take a $38 billion hit so they could snap them up on the cheap. And the losses in commercial real estate would be worse this time around as it was during the great financial crisis, because the latter was driven by a relatively short-lived recession, while today's dynamics are being driven by work from home trend, which are showing no signs of letting up unless some laws change that force people back to work or to the office. And furthermore, regional banks will be a lot more stressed, reduces their ability to amend and consent to loan modifications, given the pressure on the liability side of the balance sheet, meaning there's no way that they can afford to write down these loans to keep these commercial office building lenders in pace, to keep those loans active, to continue paying on. You are facing a brick wall, no skid mark event for the banking system. It's only a matter of time. And with the Fed's use, or with the bank's usage of the Fed facility continue to rise, is telling us we're getting very close to an inflection point. The only question now remains is when. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.